Hi there, welcome to kneppyinvests. Had a few requests if I could do a video on an update in regards to Electro Optics System, or EOS. We have seen a share price falling in recent times. In fact, the share price right now is in a well-defined downtrend. So this means at this point in time, is EOS a sell or is this a huge buying opportunity? For full disclosure purposes, I am a shareholder of this company, and to put a little bit of context around what I'll be discussing in this video, I bought EOS about 3 or 4 years ago at $2.51. And when the share price reached $9, I decided to sell out 75% of my holdings. And for about 1 month or maybe a month and a half, I thought that was a bad mistake because the share price kept on rising. In fact, the share price reached a high of $10.50 just before COVID-19. And COVID-19 has affected the operations of this company. And that's one of the reasons why the share price has dropped from $10.50 to a current share price of around $2.40. And the current share price right now is below the share price when I originally bought some EOS shares. So I'm actually looking at increasing my holdings in this company. And the one thing I'm waiting for before I do that is a shift in sentiment around this company, because the share price is decreasing, well-defined downtrend, and there's a lot of negative sentiment around this company right now. So even though I do have this question, is EOS a sell or is it a huge buying opportunity? I am a little bit biased in regards to this question, and I would be focusing more on regarding this as a huge buying opportunity. I'll try to keep my bias out of this video, but just keep that in the back of your mind if you do think I am being a little bit too biased in regards to the positiveness around Electro Optics System. In this video, I'm just going to discuss what EOS does, and then I'm going to look at the financial results for the full year or financial year 20, half-year results for the first half of financial year 21, and then look at the most recent quarterly report. We'll have a look at the cash receipts history, which is something I always do for every single company. And then I am going to discuss why the share price has been decreasing over the past few months. And it's all in regards to downgrades. And I absolutely hate downgrades. The market does as well. So I'll be discussing that. And then finally, we'll look at some of the charts, the weekly and daily charts for EOS. So before we have a look at the financial results, the charts, and why the share price of EOS is in a well-defined downtrend, just let's talk about what Electro Optics System actually does. EOS have had 3 verticals or segments: space, defense, and communications. However, they are combining space and communications into the one division. The defense division is their breadwinner right now, so they deal with remote weapon systems, counter unmanned aerial systems, ROCVs, and all that jazz. So this is where they get most of their revenue from. However, my main focus in regards to EOS is their space and communications verticals, although they're combining that into the one. I'm especially interested in their space domain awareness and the Spacelink. And I'll talk about Spacelink in the next slide, but I think there is massive potential for EOS over the next few decades in regards to their space and communications. And that's why I'm excited about this company, not really anything to do with defense. EOS released a presentation on the 27th of October titled The Communications Superhighway for the Space Economy. If you do want to learn way more about Spacelink, I highly recommend going to that presentation, and you'll learn a lot about what Spacelink is doing. I'll try to briefly explain it, but right now we're going to see a massive amount of satellites being put up into orbit, particularly low Earth orbit, or LEO. In fact, they're talking about 5,000 satellites being put up in space in 2020, which will increase to 30,000 by 2030. So there's going to be a plethora of satellites in low Earth orbit, because that's the orbit that the majority of companies and countries like to put their satellites in. And because there's going to be a plethora of satellites in low Earth orbit, there'll be a bottleneck of satellites in regards to getting traffic from space to ground, because satellites in low Earth orbit, because it's close to Earth, they're only useful for a short period of time, which means if you're a company and you have satellites in low Earth orbit, you need more satellites than if they were in medium Earth orbit or geostationary satellites. But because those satellites are a little bit higher up, you do actually spend a little bit more money. Companies just prefer their satellites to be in low Earth orbit. And what Spacelink is doing, their main clients will have satellites in low Earth orbit, but their satellites that EOS will putting up in space will be in medium Earth orbit. That means for their clients, they'll have continuous connectivity. They also have higher bandwidth, 10 to 100 times faster than traditional radio frequency. So EOS is all about opticals or optics. So they'll use that instead of radio frequency. And in their presentation, they have an indicative profit and loss over the next 6 years in regards to Spacelink. They do have to spend a little bit of money to put space or these satellites into space. I think it's $700 million. And they're hoping to fund that through $300 million of debt, $400 million of equity. But it does look like, if everything goes to plan, that Spacelink is going to generate massive amounts of cash flow for EOS. If we go to 2026 projections, $590 million of revenue for that year with EBITDA of $459 million. And the first thing you think about when you compare revenue to EBITDA is massive margins. And if they continue to increase revenue because a lot of scale, we're going to see this company produce prodigious amounts of cash over the next 5 years. We'll say 5 to 10 years. This is if everything goes right. So there's still a lot of risk moving forward with Spacelink. They do have to spend $700 million. But if everything does go right, this company is really undervalued at current valuations, which is between about $300 and $350 million. Before I get into the facts around EOS, so I am a little bit bullish in regards to the potential of Spacelink. And this is all about looking at the risks and the rewards for this company. And there are significant risks in regards to Spacelink, but the rewards, in my opinion, this is just my opinion, outweigh the potential risks. So the way I look at EOS is the potential worst case scenario is 100% loss from here. But the potential upside is 1,000%, 2,000%, 3,000%, significantly higher than the potential downside risk from here on in. And I believe the chances of success is there, that I think if you do some sort of valuation around this company, you'll get a significantly higher number than $300 million, which is the markup right now for EOS. In fact, the markup is $388 million at a share price of $2.57. The share price has continued to fall since I set up this video. Anyway, EOS was founded in 1983, so they have been around for 40 years, and they've spent a lot of money on research and development over the 40 years. And that's something else we should be excited about, or I'm excited about EOS, because there's a lot of potential in the future that we don't even know about at this point in time because they have a lot of intellectual property. They listed on the ASX in 2002 via Growth Property Investments, so sort of a backdoor listing. In fact, Growth Property Investments bought 100% equity in EOS at that point in time. CEO of EOS is Ben Green. He has a 5.3% holding in this company, and one of the major shareholders of EOS is WH Soul Pattinson. They have a 4.6% stake. And I actually do like WH Soul and Pattinson, and if they have a 4.6% holding in this company, that's good enough for me. And the ticker code of Electro Optics Systems is, naturally enough, EOS. EOS's financial year coincides with the calendar year. In this slide, I'm going to be comparing the financial year 20 numbers, which was the year up until the end of December 2020. So this is almost getting out of date, and we'll be able to see the 4-year numbers for financial year 21 in February. So it's about 3 months or 2 months away now because we're in December right now. And in this slide, I'm going to compare financial year 20 to financial year 19. Revenue did increase from 165 million to 180 million, but if I was comparing financial year 20 to, say, financial year 18 or 17, we would have seen a massive increase in revenue from those years, or over that 2 or 3 year period. Gross margins did fall from 46% to 36%, and EOS was highly operational cash flow negative for financial year 20, $109.2 million. The way I look at this is EOS has to spend a lot of money to satisfy all the potential contracts they have in their pipelines. And that's why they are spending a lot of money. That's why they were highly operational cash flow negative for financial year 20. It's all in preparation for the contracts in the future they have in the pipeline. And they were loss-making in financial year 20 by 24.4 million. However, they were profitable in financial year 19 to the tune of $18 million. They have had $23 million of net cash at the end of the financial year. Now, the net cash has been fluctuating a lot. They do capital raisings, and the revenue is quite lumpy. For instance, they received $65 million in one day, the day they released their quarterly report. Now, I've already talked about they spent a lot of money on research and development over the past 20 years. In fact, they've spent $800 million of research and development on IP, which means, well, actually doesn't mean anything, but a lot of that IP has not been exploited yet. So they have a lot of potential in the future of projects that we're not even thinking about or talking about right now. They also have $429 million of orders in their backlog, and the sales pipeline at the end of the financial year, $3.6 billion. Now let's have a look at the half-year results for EOS, which were released in August, a few months ago. And I'm going to be focusing on how each of their different verticals were doing. And the defense vertical, or their segment, or what they call the systems, is their breadwinner. That's where they get most of the revenue right now from. And for the half year, they received $83.2 million of revenue. They also mentioned the order backlog, $375 million. And they've also included something new, risk sales pipeline. And for the defense systems, that is at $2.6 billion. So what is the risk sales pipeline? That is just a risk-weighted pipeline based on assessed probability project proceeds and probability that EOS wins the contract based on customer and market analysis conducted internally by Spacelink and EOS. So potentially a little bit of bias there in regards to those probabilities. I'm not sure if they're being conservative or being a little bit bullish about the amount of contracts they might win. So I'm looking at this risk sales pipeline numbers with a bit of grain of salt. But if they do get close to that, winning those contracts, that is a significant amount of contracts, $2.6 billion just for defense systems. Communication systems revenue for the first half, $13 million, $17 million of orders in the backlog, and $478 million in their risk sales pipeline. EM Solutions, $209 million, and Spacelink, $269 million, and they mentioned there per annum. Now, for the space systems, not a lot of revenue generated just yet in the space systems, $1.6 million, only $6 million in the order backlog, and $54 million in their risk sales pipeline. We've gone from the full year results to the half year results. Now have a look at the most recent quarterly results, which is the third quarter of their financial year, the September quarter, and these results were released in October. Receipts to customers only $23 or $24 million. And because EOS does spend a lot of money, for instance, $21 million on product manufacturing and operating costs and $13.3 million on staff costs, that meant that EOS was highly operational cash flow negative by $22.5 million. And even though they were highly operational cash flow negative and they spent $6.3 million on capital expenditure, they were able to increase their cash on hand from $51.1 million to $54.9 million because they borrowed $35 million. But they mentioned in the commentary that today they received a further $65 million of new cash payments under its largest export contract. Now, I have heard someone, a fund manager, talk about EOS, and one of the reasons they don't like EOS is just their business model, particularly the lumpiness of the revenue. And to be honest with you, I don't really care how a company gets the revenue. I don't care if it's lumpy or if it's consistent and reliable. And the way I look at it is a company that gets its revenue consistently and reliable has a premium attached to their business. And I see a lot of companies that have consistent, reliable revenue, but are significantly overvalued right now. And EOS has massive potential of significant revenue in the next 5 to 10 years. I'm talking about well over $1 billion, potentially in 1 year alone. And I would prefer that sort of revenue, even if it's a little bit lumpy, than a consistent, reliable revenue that there is a premium attached to that company. I would rather that lumpiness over that reliable, consistent revenue any time of the week if the value is right for the lumpiness and the value is too expensive for that reliable revenue. One thing I really like to look at is receipts history for a company, and I actually have been following EOS since the June quarter 2013, almost 9 years, actually about 8.5 years of following this company. And to be honest with you, from the June quarter 2013, when I started following EOS, to about the June quarter, or just a little bit earlier than that in 2018, when I became really excited about EOS, receipts were just going flat, going sideways. Nothing to be really excited about this company. But we have seen receipts really explode over the past 3 years, increasing from 3.8 million to over 65.5 million in their record-breaking quarter, which was the June quarter 2021. And you can see the lumpiness here. There are some quarters where receipts are fairly, well, quite a bit lower than the previous quarter, but then you see a massive explosion in receipts following that lower receipts. And more than likely, we'll see that in the next quarter. More than likely, the next quarter, the December quarter 2021, is going to be a record-breaking quarter because we already know they've received $65 million in receipts. So sure, there is a bit of lumpiness, but the growth profile here in receipts is easy to see. It's going up through time. In fact, you could say over the last 3 years, the receipts growth has been exponentially growing, and I've put an exponential growth line in there. And that's why I'm excited about EOS right now, because it does look like their receipts are growing at a significant rate, and it might continue over the next 5 to 10 years. I've talked about why I'm bullish about the long-term potential around EOS. Now let's focus on why I'm a little bit bearish about the short-term share price for EOS. I think this is one of the reasons why we've seen the share price take a hit over the past few months. And it's all because the company has issued 2 downgrades over a 2-month period. The first downgrade was released on the 30th of August, and the second downgrade was released on the 27th of October. It's not a good look when a company issues downgrades, and the market and I absolutely hate it. And this is one of the reasons why I believe the management of companies should be way more conservative in their guidance, because if they are conservative, there's more chance that either they'll hit guidance or even exceed guidance, way more chance. And the reason I think management should be focused on beating guidance is the market absolutely loves when the management of a company exceeds guidance or releases upgrades in regards to exceeding guidance. For some reason, the market absolutely loves that. But when a company issues downgrades, the complete opposite. The market absolutely hates it, and the share price will take a massive hit when a company issues downgrades. And this is the reason why the share price of EOS right now is in a well-defined downtrend, and there's a lot of negative sentiment around this company. They've decreased revenue guidance from about 235 to 245 million, all the way down to 215 to 220 million, and underlying EBIT after Spacelink cost, they've decreased that guidance from 3 to 8 million to negative 11 to negative 15 million. So that has or is a significant decrease in guidance over a 2-month period. Onto the weekly chart for EOS, and if you're a long-term shareholder of this company, maybe it's time to look away, because what's been happening with the share price for this company over the past year is not a good look. From the start of this period, which was 2014 to just before COVID-19 financial panic, there were a lot of positive sentiment behind this company. Share price increased from 50 cents to a high of $10.50. We also started to see increasing volume during 2019. In fact, during 2019, share price increased from $2.50 to that high of $10.50. But COVID-19 has severely or significantly affected EOS. And that's one of the reasons why they've actually downgraded guidance. But they should have been aware of that, and they should have been a little bit more conservative in their original guidance. And that's why we have seen the share price move into a well-defined downtrend from the start of this year. So in December, November last year, the share price was hovering around $6.50 to almost $7. And now it's around $2.40. And in fact, the share price right now is well below the lows we saw during the COVID-19 financial panic. And the last time we saw share price this low was right back at the start of 2019. So I'm becoming a little bit more interested around where the share price is right now for EOS, because I think the market is punishing EOS a little bit too much, and it is becoming a little bit more attractive. But because the negative sentiment is so bad around this company right now, I think there is potential the share price could fall significantly further from where it is right now. That's all I have for this video on EOS. Is EOS a sell right now? I think the best way to think about this is, are you in EOS for the short term or the long term? If you're in EOS for the short term, I'm not sure why you have a position in this company, because the share price is in a well-defined downtrend, a lot of negative sentiment. I only see the share price falling from here until we see some signs that the bottom has been reached. But this could be a good buying opportunity for the long term. And if the share price falls even further, I am thinking of adding to my position if I get confirmation that the sentiment is starting to shift around. If you have any questions about this company or any other company on the ASX, please leave your thoughts, your comments, your questions in the comment section of this video. Otherwise, I am not a financial advisor. If you do need financial advice, make sure you seek out someone who is qualified and can speak to your own financial needs. That's it for this video. Have a good day. Bye.